Hey everybody, Brian Lauer, One Life Financial Group. We're in a fun wealth marathon series using some running stories and analogies to teach and explore how investors could get more potential mileage out of their hard-earned money. If it's your first time, welcome to the channel. We're walking through 7 risks of running your wealth marathon without any support. So today's video is covering risk number 3 of 7, which is you could run off course with your tax minimization strategy. I fully believe that marathon runners and investors have the same goal. Runners want to be as efficient as possible when going from point A to point B in their marathon, which is a 26.2 mile foot race. Similarly, investors want to be as efficient as possible in their wealth marathon when going from point A to point B in their life with their financial goals. Successful marathon runners and investors don't want to go off course. They don't want to waste precious fuel, or the technical term for runners is glycogen stores, the body's preferred source of energy for marathon races. And investors don't want to waste their precious fuel or their money, their wealth, when they're going from point A to point B. They both want to take the optimal wealth management strategy and tax minimization strategy in their financial plan. And runners want to do that in a race. So I've been helping families manage their wealth for over 2 decades, but I'm a rookie at marathon running. And speaking of rookie mistakes, I was literally steps away from going off course down at the Kiowa Island Marathon several months ago in Charleston, South Carolina. Let me share a quick story about this, and then I'm going to tie that into the potential consequences investors can face when they go off course with their tax strategy. All right, I had some issues at the Kiowa Island Marathon that I did not run into at my first marathon last year up at Grandma's in Duluth. Number 1, there were many turns. Number 2, it was hotter than expected. And number 3, I was a little bit out of it race week. I was delirious. And somewhere around the 17-mile mark, the pack in front of me that I was running with for most of the race, they started to pull away. They were chasing that sub 3-hour mark, and there weren't as many runners down in Kiowa Island as there were in Grandma's, and so I didn't have anybody to follow. My head was down, or I was just completely clueless about the sign in somebody's yard that had an arrow pointing to the left. And thank goodness a race volunteer or a supporter yelled, "Turn left!" I was steps away from going off course and just running straight. Without that support, I would have ran off course. I ended up waving and laughing and yelling thank you. But how bad would it have been to train for hundreds of hours for a marathon and then go off course? Some consequences could have been, for me, the obvious. You waste some extra energy and you're not efficient going from point A to point B. Number 2, you could fail to reach your potential goals because you're running longer than you have to, and you could get disqualified. So thank goodness I had some support, and I'm not sure what your name is, but thank you. You helped me potentially qualify for Boston because I ended up just over 2 minutes below the cutoff. And so I was grateful for that support. Now, what does all of this have to do with running off course with your tax strategy in your wealth marathon? Well, just like runners can be at risk of running off their optimal course without any support, many investors have their head down. They're busy with work, they're busy with family, kids activities, home projects, or they're training for a marathon and they're busy, diving into their Strava stats, and they just don't have the time or energy or the expertise or the tools to minimize their tax bill proactively throughout the year. Now, in today's video, I can't list every single reason or every single strategy that you should consider for your unique situation, but I'm going to share one of the top 3 reasons I believe investors go off course. And today it's with their tax strategy. If you want to get notified for the second and third reason that I believe investors go off course, make sure to hit that subscribe button so you can be notified next week. So the first reason I believe investors go off course and not be efficient is reactive tax minimization. Okay. Too many investors wait. What is this? Too many investors wait until that tax filing deadline or close to that deadline, April 15th, to talk to their accountant about opportunities or what they should do. And The problem with that is that many of the tax planning opportunities expired on December 31st the prior year. Okay? So they missed the turn. Essentially, they're past the turn for many of those opportunities. And when you miss those opportunities, it could be like a marathon runner who missed a turn. You can waste fuel, you can waste money, you can pay unnecessary taxes, so you're not as efficient going from point A to point B. Now, sure, there are some opportunities that still exist between January 1st and the tax filing deadline. Maybe like making an IRA or Roth IRA contribution if you qualify. Profit sharing contributions or even HSA contributions can be made after January 1st. But many of the tax minimization opportunities that could lower your tax bill this year or in future years expire on December 31st. For example, if your retirement projections and lifetime tax bill suggest that you should shift your retirement contributions from a Roth 401k to a pre-tax 401k, it's too late after December 31st. Or if you wanted to max out your plan, it's too late after December 31st if you didn't hit the maximum, which could cost you some tax savings. Same thing with charitable giving. That deadline's December 31st, and there are many ways that you can give to charities. Outside of giving cash, you could give appreciated stock. You could open up a donor-advised fund. You could give from an IRA if you meet the requirements. But after December 31st, you're not able to make a contribution for the prior year. So marathon running is crazy similar. If taxpayers miss an opportunity, they're like a marathon runner who's off course. They're not as efficient as they could be. So in summary, you could be more efficient if you're proactive, if you don't go off course, and if you capture opportunities that could benefit you before the end of the year, before that expiration date, instead of waiting until after January 1st to do tax planning. All right, so what are some reasons investors might go off course with their tax strategy? Number one, like me, they had their head down. Number two, they didn't prioritize tax planning throughout the year. And number three, they didn't have the tools, the tax planning or the financial planning software, or the expertise to do the work. So just how costly is it to go off course with your tax strategy? That's a difficult question because it depends on your situation and how large of an opportunity you could miss if you went off course with your tax strategy. Some strategies that are missed could cost hundreds of thousands of dollars over a lifetime, or even millions. Let me give you a hypothetical example. Savvy Sue's financial planning strategy called for $500,000 of Roth conversions in her plan over 5 years. Okay, a Roth conversion is where you pay the tax on a retirement account and you move it to a Roth account that can grow tax-free. All right. So Sue's wealth manager was monitoring her accounts in March of 2020 when COVID impacted the financial markets and the markets went down. They called Sue and finalized a strategy quickly to convert $100,000 from pre-tax retirement accounts into her Roth IRA. Sue paid 22% in taxes, federal taxes on her Roth. And while it was a big check, she was okay with that because the market was down. She thought it was a good deal. And her financial plan projected her tax rate to be about 10% higher in the future. Sue looked back and saw that $100,000 had grown to $200,000 when she needed money from her Roth IRA to purchase a cabin with her twin brother Larry. And she was thrilled because the $22,000 in taxes she paid grew to $200,000. She won't have to pay a dime on that, as you can see in Sue's scenario on the screen. All right, and Larry, her twin brother, is going in on the cabin with her, 50-50. Let's compare Sue's scenario to her brother, which who she calls Lazy Larry. They were twins. Their financial pictures were identical. Same income, same goals, same life expectancy, same retirement account values, same net worth. But Larry didn't have a financial plan. He didn't have a tax minimization strategy or even know what Roth conversions were. Larry didn't have anyone proactively monitoring his accounts for tax minimization opportunities. Sue told Larry, hey, you got to meet with my wealth manager and accountant. And Larry skipped the appointment because he had an important episode of Ted Lasso. So instead of doing a Roth conversion, as you can see on the screen, Larry kept that $100,000 in his pre-tax account. He didn't do a conversion. That account was invested the same as Sue's. It grew to $200,000, and like his twin sister, he pulls $200,000 out. The problem is he's in the 32% tax bracket. He pays 10% more in taxes than Sue, but he doesn't pay it on the $100,000. He pays it on the $200,000 that the 100 grew to. It was never moved to a Roth IRA. So in the 32% bracket, Larry's paying $64,000 in taxes on that initial 100 that grew to 200. That's $42,000 more than Sue during the same time period. That's a huge financial cost to Larry for going off course. However, it's not the end of the story with taxes. And when you go off course, there's even a larger potential cost called opportunity cost. So let me explain. Take a look at that image on the screen. You can see that if Larry paid $42,000 in unnecessary taxes, if he could have left that money invested in a hypothetical account, let's say it grows for 40 years and earns 9%, it would have grown to over $362,000. Okay? Isn't that crazy? So let's recap. Let's talk about steps you could take to potentially help you from missing a tax minimization turn or an opportunity. But first, I have to give you a couple disclaimers. Number one, I am not suggesting you should do a Roth conversion because your plan and tax projections are unique to you. In fact, a Roth conversion might not make sense if you're projected to be in a lower bracket when you take money out. And I'm also not suggesting that you can earn a 9% rate of return guaranteed. Investments could lose value. They could earn more than that or less than that. So to recap, runners and investors have similarities. It can cost precious fuel or glycogen stores for runners and money for investors if they go off course. Number two, just imagine a marathon with no water tables, aid stations, course markers, or volunteers telling you to turn left. It would be a lot easier to go off course without support. So similarly, investors can be at risk of going off course if they don't proactively practice tax minimization, or if they just don't have the support they need, if they're too busy, or if they don't have the tools or the expertise to do that work themselves. So if you're running a wealth marathon alone and you want some support or a second opinion to see if you might be potentially missing an opportunity, click that button on the screen. You can request an initial consultation. You can also hit that subscribe button to get notified when next video comes out. And I'm going to share what I believe is actually the number one reason investors are inefficient or go off course with retirement planning. So as always, thanks for tuning in. If there are any wealth management topics you'd like to address in future videos, feel free to let us know in the comments section below. And finally, I actually have a little bonus for you. If you want to take a free assessment, we have a tax minimization assessment. Click that button on the screen or take a look in the show notes below. You can take that. It's on our website. It only takes a few minutes, and you might be able to uncover an opportunity or two that could potentially lower your tax bill. It was great being with you. We'll see you next week.